Welcome to this week's market presentation. Latest news. The president of Turkey visited President Trump at the White House this past week to discuss the lifting of a U.S. ban on F-35 fighter jet sales to Turkey, as well as to reset strained bilateral relations after years of defense, sanctions, and regional disputes. Talks also address Turkey's purchase of Russian S-400 surface-to-air missile systems, as well as U.S. support for Kurdish factions in Syria, as well as wider trade and economic cooperation. The impact on energy markets, however, remain to be seen. President Trump tried to pressure Turkey into moving away from Russian energy imports, particularly crude oil purchases. If Turkey accommodates the request by President Trump and the United States, we could see a decline in purchases of Russian oil and gas from Turkey, potentially tightening other sources of those commodities. Additionally, an improvement in the relations between both countries could see a positive impact on the peace efforts in the Middle East, although the current outlook remains highly uncertain. In another visit to the White House, President Trump met Israeli Prime Minister Netanyahu this past week, engaging in intense negotiations regarding the situation in Gaza. Netanyahu has expressed reservations and pushed for changes, particularly opposing aspects related to a Palestinian statehood, as well as the role of the Palestinian Authority. President Trump stated his continued optimism regarding a peace deal, stating that negotiations were in their final stages, although for the moment no concrete progress has been reported on. The impact on energy markets again remains to be seen as how the situation develops, given Israel's opposition for the establishing of a Palestinian state and the condemnation of particularly Gulf countries and others around the world on the situation. We could continue to see this conflict draw out further. In recent news impacting primarily crude oil markets, the European Union reimposed economic sanctions on Iran after the United Nations triggered snapback mechanism. Sanctions have frozen Iran's central bank assets as well as has banned crude oil trade and gold sales. Triggered by E3 over Iran's nuclear non-compliance, the Security Council blocked the attempt to stop the snapback. The renewed sanctions on Iran's crude oil exports are expected to tighten global oil supplies, exacerbating price pressures amid already strained markets, particularly affecting buyers dependent on Iranian oil, such as China and India, as well as some European countries. Weather. Looking at the weather forecast for the next 7 to 10 days, we see relatively mild temperatures in line with the seasonal average. At the beginning of the week and through the end of this week, we are expected to see below average temperatures across most of Western and Central Europe before warmer weather begins crawling in through Western Europe at the beginning of next week. Precipitation, which will remain rather limited through the beginning and middle of this week, is expected to pick up over the weekend and into next week over most of Western Europe. And then lastly, in terms of wind speeds, we've seen a decline in average wind speeds over the past few days, and that is expected to continue over the next 7 to 10 days, painting a less optimistic picture for wind power generation. Lastly, after a very uneventful hurricane season, this week potentially brings more activity with a tropical storm named Imelda and a Hurricane Umberto off the coast of Florida in the Atlantic. The latest modeling continues to indicate that both tropical storm and hurricane will drift towards the middle of the Atlantic without making landfall in the U.S., and most importantly, without leading to a negative impact on U.S. LNG export activity or oil and gas production. Macroeconomics. Updated GDP figures for U.S. growth over the second quarter showed a stronger performance than previously reported on. Quarter-over-quarter growth for the second quarter was revised up to 0.9%, up 1.1% versus the previous quarter. Year-over-year GDP growth also saw a slight upward revision now to 2.1%. This will certainly boost some demand expectations in the US, especially given the interest rate cut that was announced the week prior. Crude oil and LPG. Global crude oil prices saw an uptick in the market, with the front month moving up roughly 5.3% on the week, with the frontier increasing around 4% for both Brent and WTI crude oil prices. The uptick in the crude oil price was likely driven by both the changes and the updates regarding demand supply. On the demand side of things, the revised figures on the US economy likely added to those stronger demand expectations, especially given the interest rate cut announced previously. On the supply side of things, markets are now expecting tighter conditions than previously. Part of that is certainly the prospect of Turkey moving away from Russian oil, given the pressure by President Trump for them to do so, as well as the prospect of additional sanctions by the US and the European Union on Russian energy exports, specifically targeting oil and gas exports. Additionally, we are seeing the prospect of the continued conflict in the Middle East adding to the geopolitical uncertainty, as well as the ongoing situation in the war in Ukraine, where Ukrainian drone attacks on Russia's refineries are keeping roughly 20% of capacity offline. One still bearish signal in the market is the continued production increases by OPEC Plus, which went ahead as announced for the month of October. The group is expected to meet this Saturday to discuss future increases in production, so yet to be seen how that will play out. Natural gas. Moving on to natural gas markets, we see a very stable evolution over the past week. Both the last quarter of 2025 and the front year of 2026 saw increases of just 0.4 and 0.5 percentage points respectively, as markets appear to be in a more wait and see mode this week as we get closer to the winter months. US gas storage levels increased to around 82% as of the end of last week, in a slowing increase over the past week, with the injection rate falling below the average of the last 12 years and getting closer to the levels we saw last year. Overall, the storage deficit versus the previous year has remained stable at around 12%. Given the current jet of injections and current storage levels, the expectations are still that the storage targets set by the European Union will still be met on time. Looking at total supply and demand, there was a sudden and sharper increase in total demand over the past week, pushing up from the lowest levels over the past 5 years to now the levels in line with 2023 and 2024. At the same time, we are seeing once again a more continued improvement in the supply outlook, which was primarily driven by an uptick in Norwegian gas flows, now once again up to 300 million cubic meters per day, and ending or nearing the end of this maintenance season on schedule and without additional delays or maintenance needs. LNG sendouts did see a slight drop over the past week, in part as a response to the uptick in Norwegian gas flows, although when we look at LNG imports into Europe, those have continued to increase over the past week, pushing up above the levels seen in 2023 and 2024. In terms of the quarterly share in the EU gas import mix, especially looking at Russian imports, we see that Russia is still supplying roughly 11.4% of gas imports to Europe. And as a result, the pressure by the US in particular to force European countries to move away from Russian energy imports still represents a significant share of the total gas mix. Coal. Moving on to coal markets, we see a slight bearish price evolution over the past week, particularly on the API2 forward year price, decreasing by 1.8% over the past week. European coal prices continue to be weighed down by the overall weak demand across Europe, in part due to the better performance of renewables, the lower overall demand, as well as the competitive of gas-fired power generation. At the same time, ARA coal stocks in Europe have maintained at an ample level, and water levels along the Rhine remain more than adequate for the transportation of coal. Over on the Asian side of things, we're seeing a stable price evolution, although more mixed fundamentals. On the supply side of things, weather conditions in Indonesia are weighing down domestic production, limiting export activity. At the same time, demand from both India and China could see increases in the coming weeks. In China, due to the reduction in domestic production, and in India, as we move away from the monsoon season, and as we're seeing overall coal-fired power demand increasing over the past weeks. EU and UK emission allowances. In terms of emission carbon allowances, we finally saw a slight respite from the bullish price evolution we were seeing up to this past week. On the European side of things, prices came down 2.3% on the spot market and 2% for the December 25 product. Or on the UK side of things, we saw more bearishness with prices decreasing roughly 5.6% on the week. Carbon emissions from the power sector in Europe remain near the bottom of the range over the past 5 years, although the uptick in gas consumption also within the power sector did lead to overall emission levels increasing just above last year's levels at this time of year. In terms of the investment fund positions, the increases in the level of long positions has slowed down, although we still see those at record high levels, in part due to the high prices that we currently see in the market. On the UK side of things, as talks continue around relinking the EU and UK carbon markets, we continue to see that support long positions in the market. On the European side of things, as we are very much near to the September 3rd compliance deadline, we did see some more activity over the past week, but then that will be expected to ease moving forward. Lastly, on the European side of things, a little more clarity on the CBAM were announced, where it indicated that importers that import less than 50 tons per year will be exempt from the new regulations. That will exempt roughly 90% of importers. But what is most important is that the remaining 10% for which it will continue to apply are responsible for probably 99% of emissions. And so the policy will still target emission reduction significantly. Electricity. In terms of electricity markets, we see a similar evolution with more limited movement over the past week. But nonetheless, we did see electricity prices in the first half of the year decreasing by roughly 1.5%. For the frontier on the whole, we saw a decrease over 1% over the past week, with prices further along the curve seeing more limited movement. The price evolution was very similar across other European markets, with some seeing some more bearishness, particularly the French market, in large part due to the uptick in French nuclear power output. Over in the Nordics, the dry weather we've been seeing really throughout this past summer has been adding pressure on the market, which has led to slightly more bullish sentiment there. Moving on to total supply and residual loads, or total demand and residual load, we see that uptick in residual load over the past week, moving up above last year's levels for this time of year. In terms of the supply mix, here we see that sharp increase in the French nuclear power output, now significantly above the highest levels we've seen over the past 5 years. This has been welcome news, as it will help ease the pressure on fossil fuel power generation, helping ease pressure on the market. In terms of renewables, what we see here is a decrease in output over the past week, as both wind and solar power generation saw week-over-week decreases. In terms of fossil generation, the decrease in renewables did lead to an uptick in natural gas-fired power generation in particular to compensate for the drop in renewables. As we can see here, following much higher levels of wind power generation over the previous week, over the last 7 days, we've seen that drop down now closer in line with the average over the past 5 years. Then over in the solar power generation side of things, we continue to see the trend of decreasing solar output as we move further into autumn, although it must be noted that we're still seeing output at record highs. Lastly, looking at hydropower generation, we do see that reservoir generation is below the past 5-year average as the drier weather has continued to weigh on output. Although weather forecasts of additional precipitation in the coming weeks could help boost output. In terms of fossil and biomass generation, we see that uptick in fossil gas generation over the past week to compensate for that drop in renewables. We see a similar increase in coal-fired power generation, although slightly less of an increase compared to natural gas. Lastly, looking at guarantees of origin, following those sharp drops over the past week, we've seen a slight uptick in the price level over the past week. We're still seeing quite a bit of activity over the last few weeks in the market as market participants settle their positions for this year and for the following year. That covers this week's market presentation. Thank you for joining.